Hello, welcome to my channel. If you are new and welcome back, my name is Christy Carter. I am the owner, CEO, and founder of C-Squared Finance. C-Squared Finance is a full cycle accounting and tax corporation. So, in this video, as you can see from the title, we're going to discuss the differences between a C Corp and an S Corp and go over the key points and highlights of both, key points, highlights, and characteristics of both so that you're clear on how they both are structured and you can make a informed decision on how you want to structure your business. So let's get into it. First thing I'm going to do actually is share my screen so that I can show you exactly what I am talking about. Okay, so I created a spreadsheet that outlines a C Corp and S Corp structure. So I'm going to give a scenario. Let's say that you created a business, you received $200,000. You calculated everything, you tracked it, you hired someone like myself. Or you did it yourself. You did it in a spreadsheet. You did it with QuickBooks Online. You did it through Xero, Sage, any of the accounting software that exists in today's time. And you found out that you received $200,000 in total from your customers and clients throughout the year. With the S Corp, one of the main requirements is that you hire and pay yourself as an employee because you're working in the firm. This is a non-negotiable. So let's say, for instance, you are a State Farm agent and you have about 10 years experience selling insurance. Let's say the average, so what you have to do is you have to find out what the average salary of somebody with your skill level and your experience makes. So let's say, for instance, just for the example and for simplicity, let's say the average salary is about $100,000. So the IRS requires that you pay yourself a reasonable salary. And so you have to do your due diligence and calculate exactly what that is. So $100,000 is what you pay yourself throughout the year over the span of the 12 months. So with that being said, because you are paying yourself, you are responsible for self-employment tax, and that is a combination of Medicare and Social Security. And so because the corporation is responsible for a portion and the employee is responsible for a portion, the total amount is going to be 15.3%. And because in this scenario, you're acting as both, you are the corporation and you are the employee, you are going to pay the entire 15.3%. So it's going to be 7.65% for the employer and 7.65% for the employee. And like I said, 7.65 times 2 is 15.3%. As you can see from my formula, it's going to be your gross wages of 100,000 times 15.3%. That equals $15,300. So after you paid yourself $100,000 out of the gross earnings of $200,000, there is a profit remaining in your business of $100,000. What we're going to do is we're going to move over because this is a pass-through. Pass-through means that any revenue that your corporation makes is passed through on the tax side onto you. So this is a income bracket for 2025. This is the most up to date. I am recording this video in January of 2026. And so this is from 2025. Let's say, for instance, you are a single filer. You're not married, you're single, and you make $200,000. So we're going to move over here to this tax bracket. And so there is a lot of misconception, and a lot of people think that if you make $200,000, that you have to jump down here to the 32% tax bracket and pay 32% of 200,000. So just for fun, let's see what that amounts to. That's not correct, but let's see. So 200,000 times 32,000, sorry, times 32%, 64,000. That's not how it works. Let me show you exactly how it works. It will be thorough and it will make sense to you. Okay, so as you can see, there's different tax brackets and it is itemized separately. So for instance, on income up to $11,925, you are set to pay 10% on that. And of course, 10% of $11,925 is $1,192. And as you can see, I did the math in this spreadsheet, and that's exactly what it equals. Because you made more than $11,925, we're going to keep going. So for instance, if you only made if you brought in 100,000, sorry, if you brought in $1,000, right? If you brought in $1,000, you paid 10% because that $1,000 is accounted for in this scenario, up to 11,000. You only made 1,000, right? Then you would pay 10% of 1,000, which is what, 100 bucks? But because you made $200,000 in this scenario, we're going to keep going. So yes, you are paying 10% at 11,925, which is 1192.50. So I'm going to keep going. Now we're on the 12% tax bracket. And so of course, as you can see, income up to $48,475 is going to be taxed at 12%. And so this is the taxable amount. It's going to be 36,550. You might be wondering, how did I get this number? What I did was I subtracted $11,925 from 48,475. And that equates to 36,550. If you multiply 36,550 times 12%, as you can see from my formula, you get 43.86. So far, you owe the IRS $5,578.50. Because you made 200, we're going to keep going. You made $200,000. Your gross receipts are $200,000. We're going to keep going. So the third tax bracket, 22%. This is going to be on income up to $103,000, $350. So same thing like I did in the previous scenario is I subtracted 48,475 from 103,350 bucks and got 54,875. And you can see from this spreadsheet that that math is right here. So basically you are going to pay 22% on $54,875. That equates to $12,072.50. 54,875 times 22%, 12,072.50. So far, you owe the IRS 17,651. Now, the majority of your income is going to be taxed at 24% because you can see here, same thing was done. I subtracted $103,350 from 197,300, which is this tax bracket right here. When I did that, as you can see, here's the equation. That equates to $93,950. So that amount is going to be taxed at 24%. As you can see from my formula, 93,950 times 24% equates to 22,548, which is like the bulk of what you owe in comparison to the previous tax brackets. So now we're going to go on to the last one because as you can see, this 197,300 is less than the 200 that gross sales came in. And so we are going to go on to 32%. And as you can see, this range is from 197,301 to 255,255. We're going to stop here, of course, because you didn't make more than 250 in this scenario. So what I did was I subtracted 200,000. Sorry, I subtracted 197,300. Sorry, we're on the last one. Okay, so taxable amount right here. I subtracted $197,300 from 200,000. And that equates to $26.99. So basically you're going to pay 32% on $26.99, and that equates to $863.68. And there is my formula right there. If you would like this spreadsheet, feel free to comment below, let me know, send me an email, and I can send this to you at no cost, and you can play around with it and get a full understanding of how everything works. So basically, once we go through all 5 of these, it totals out to about $41,062.68. Of course, that is less than the scenario that I gave you earlier of 200,000 taxed at a 32%, which is 64,000. So this is for our benefit. IRS it hasn't done it so harshly. We still have to pay a hefty amount, but it's not that clean cut, and you don't have to pay $64,000 on 200. It is broken up accordingly. So basically, yes, you owe $41,062.68 on federal income tax. And this is showing up on your um it's showing up on your Schedule C 1040. So with that being said, the total amount you would pay in this S-Corp scenario is you would pay the self-employment tax that I discussed earlier, the 15.3%. That is going to be paid on your salary as a W-2 in addition to the 41. So 15,300 plus $41,062.68 equates to $56,362.68. That's a pretty penny. And so the fun part is that there are ways to lower your income tax liability. There are so many so many deductions that will lower your income tax liability. And for the simplicity of this video and for it to not be an hour or two long, I'm going to go over two different ones. So there is a standard deduction, and I did my research and looked it up. And for 2025, it is 15,750. This is for a single filer. It's going to be different depending if you're married, filing jointly, filing separately. But for this scenario, for a single person, the standard deduction is 15,750. And then another deduction that we're going to go over briefly is a QBI deduction. QBI stands for Qualified Business Income. So there's a qualified business income that anyone who makes under $247,500 qualifies for. So this is going to be taken off 200,000. So if you summarize these two, if you add together 15,750 plus 20% of your wages, 100,000, you get 35,750. So this is 15,750 plus 20,000 equals 35,750. Like I said, this 35,750 is going to be deducted off of the $200,000. And so now that $200,000 is going to go down to 164,250. This is the taxable amount after all of the deductions. And so now this tax bracket is going to look a little bit different than the one we went over. We're stopping at 24%. Up here, it went all the way down to 32 because 200,000 is in this range. Because we have lowered the tax liability by using these two deductions, for example, now we are going to stop at 24% because 164,250 is within this range. So the difference, as you can see, for the 24% tax bracket, you're paying 24% on $60,900 instead of paying 24% on $93,950. And so the total after these deductions that you would owe for federal income tax is now going to be $32,267. And as you can see from my formula, totaled it out exactly. This is the federal income tax. FIT means federal income tax liability after deductions. And we still have to take into consideration the 15.3% on the $100,000 wages that you made as an employee. And so the total after deductions that you would pay is going to be $47,567. This is about $10,000 less than what you would be paying in a scenario where deductions were not taken. So as you can see here, 15,300 plus 41,062 is 56,362.68. And then in this scenario, the better scenario, you are only paying 47,567. And there's ways to plan for this so that you don't get a shock at the end of the year / beginning of the year that you have to pay. If you want some details on how to do that on tax planning and strategy, I do that as well. Feel free to reach out to me and my firm. But basically with a S-Corp, there are about 3 forms that you have to file each year. You would file your, it says form instead of form. You would file your Form 1040, which is your W-2 salary of $100,000. You would then file a 1120S, and the 1120S is going to show the revenue, gross revenue of $200,000, gross receipts, that's what I should put, gross receipts of $200,000. And I took a screenshot of a portion. And as you can see from my screenshot, on line 1A, it says gross receipts and sales. This is where you would put your amount that you brought in to the business, the amount that your customers and clients paid you throughout the year. So if in this scenario it totals 200,000, that's where you put that right here. And of course, this 1B is for refunds and things of that sort. We can go into detail in that in a different video, just to take some time. But basically, this is where you will record your gross receipts and wages, not wages, sorry, your gross receipts and sales. And then there is one more form that you would file, this Schedule K1. The Schedule K1 is part of the 1120S. And this basically acts like a 1099 in a sense. This is not W-2. This is not, yeah, this is not a W-2. This is a pretty much a 1099 in a sense. And this is where you would report the profit, the remaining profit. So the 200,000 minus 100,000 is 100,000. This $100,000 gets reported on your Schedule K1 right here. And that's going to be put on line 1, ordinary business income. So I hope that makes sense. I hope that, yeah, I hope that makes sense. And now we're going to go over C-Corp, C-Corp characteristics and details. This is going to be just as thorough, but this is a little quicker and easier to explain. So just for simplicity, we're going to keep the same sales. We're going to keep the same amounts. So your business made $200,000, right? And then you, in this scenario, that's what I want to say. That's what I want to highlight. In this scenario, you don't have to pay yourself as a W-2 employee unless you are working in the corporation. So let's say that you are. Well, yeah. So if you're not working in the organization, you're not spending your time and you're not in the day-to-day tasks and you're not really working in it, it's just kind of a well-oiled machine, then you would not have to pay yourself a salary. This is when you can skip that step. But if you are working in your business on a day-to-day basis or on a weekly basis, often enough, then the IRS is going to expect that you pay yourself. So let's say that you are involved in your business and most of the tasks. You would still pay yourself a reasonable salary based on your experience, education, years of, yeah, years of experience, education, so on and so forth. So you pay yourself a W-2 salary of $100,000. Of course, you still have to pay 15.3% on self-employment tax, which is including Social Security and Medicare. And so 15.3% of $100,000, same thing, is $15,300. You're paying 76, yeah. So you pay yourself the salary. Next step, and the one of the highlights of a C Corp is the fact that there is a set corporate tax rate of 21% in this scenario. So you made $200,000, you paid yourself 100,000. Now there is $100,000 sitting in your corporation as corporate profit. Unlike an S-Corp, you are going to be charged a set rate of 21%. It's not going to be like the federal income tax bracket that we went over, where there's 10%, there's 12, 14, 10%, 12%, so on and so forth. It is going to be set 21% no matter what. So if you do the math, 21% of $100,000 is $21,000. And you can see from my formula, I did the math for you and for me, and that is 21,000. So if you take 21,000 and subtract that from your remaining corporate profit of 100,000, there is still $79,000 sitting in your corporation that you can either leave in there or you can take. So a scenario could be that, yes, you paid yourself $100,000, but what if you want more money? What if you need more money? We're living in 2026 as I'm recording this video. Everything's expensive. So let's say you want more money. There's money to be had. You made the money. It's your money. So let's say you want to hire. Let's say you want to reinvest back into the business. Let's say you want to go on vacation. Whatever you want to use it for, that is your prerogative. So let's say you want to take the rest of this out. So there's $79,000 after you have paid self-employment taxes, after you have paid the corporate tax rate of 21%, and now there's $79,000 sitting in your corporation. You pull out the rest because you're like, hey, this is my money and I want to do this, and this with it. You get to do that. However, the thing about a C Corp, you are double taxed. So if you take out $79,000, which is the whole thing in this circumstance, you're going to pay an additional 15% on that. So you get taxed pretty much 15.3% as a W-2 employee, and then you're getting taxed again 15% shareholder tax on any dividends that you take out. So taking out profits from your business in a C Corp formation is called a dividend. So there is a shareholder tax of 15% for taking out any money outside of your salary. So you don't have to take all of it. Let's say you want to take out $10,000. Then you would pay an additional 15% on $10,000. And that is what, $1,500? So it's up to you. But this is why there are some people that are okay with this scenario. And then because some people leave the money in. And if you leave this $79,000 in your corporation, then there is no tax to pay. However, if you take the money out, you're paying tax again. You're paying it on a employee level and sorry, you're paying it on an individual level, and you're also paying it on a shareholder level. So these are both individual levels, so you're paying it twice on top of the corporate tax rate of 21%. So the lowest that you would pay in this particular scenario would be 36,300. I got that number by adding together the self-employment tax of 15.3% of 100,000 and the 21% corporate tax rate on 100,000. And that, of course, equals 36,300. That's the lowest you could pay in this particular scenario. If you wanted to take out the remaining 79,000, you have to pay 15% of that, and then that would equate to this $48,150 number. And I will show you how I got that. So of course, that's the 15.3% of your salary. That is the 21% tax rate, and that is 15% of the remaining 79,000. So that equals 15,300, 21,000 plus 11,850. Remember, this is only if you were to take out all of it. If you were to take out half, then you'd pay half of this, so on and so forth. And the thing that I want to point out about a C Corp is unlike an S Corp, you do not qualify, the corporation does not qualify for any deduction. Well, they don't qualify for the same deductions that I mentioned in the S Corp. So there is no standard deduction. Standard deductions are on the individual level. This is a corporation. So there is no standard deduction, and there is no qualified business income deduction. So this isn't going to be lowered like it was in this scenario where, you got to take these two deductions off of your income and lower your tax liability. So that is pretty much in some I'm going to stop sharing. That is pretty much a breakdown, key points, characteristics of both. I hope that you feel empowered to make a decision and to choose a corporation that works best for the structure of your business. If you would like me to go into more detail about anything that I mentioned today in today's video, feel free to comment below and let me know. I'm happy to do that. There are plenty more deductions that can be discussed. I can also go into detail about the 1120 and 1120S and certain deductions that count, that don't count, percentage of it that counts. And so basically, I want to thank you for watching the video. If you are interested in using any of my services, my accounting, bookkeeping, tax prep, tax strategy services, feel free to look at the description box below and send me an email. My email address is info@c-squaredfinance.com. And if you're interested in having your current financial records analyzed, I have an offer that I've listed below in the description box as well called the Royal Clarity Accounting Assessment. And also, if you want to learn more about my journey to entrepreneurship and business, feel free to watch this video right here. I have been in business for about 10 years. I love what I do. I love the impact that I make, and I'm happy to share that with you. And so, thank you again for your time. And feel free to subscribe, like, comment, and I will see you in the next one.